A very good afternoon. You're watching the newsroom right here on ET Now. I am Ajay Sharma. The markets are in a recovery mode right now as we speak. Off-lows. Very important commentary coming in on your screens right now is from Unilever management. They have actually raised the guidance for sales going forward because they've been able to take price hikes, and it has met inflation issues very smartly and very nicely. They are also saying that inflation levels are likely to peak out in the second half. Let's also get in Trideep Bhattacharya, who is joining us now on the show to talk more about this, because Trideep, afternoon till morning, the worry was Walmart came out, and weak Walmart earnings and guidance also hit Amazon. And generally there was a sense that growth is an issue. Inflation as an issue is, with each passing day, no longer that big an issue. Growth is. But if Unilever comes out and raises the guidance and says that things are manageable, we should take note of that, isn't it?
Absolutely. I think it's a very good question. Thanks, Ajay, for inviting me on your show. I would say, as if you regress the last 6-7 months, the lead indicator for the trouble in global markets was actually inflation, which drove interest rates high, which ultimately led to softness in demand and hence and so forth. So if inflation is ebbing, which is what my hypothesis also is, that in the next couple of months, the inflation should ebb and gradually come down. Not to say that we will go down to as low levels as we have seen in last year, but it will certainly go down from where we are today. If that be the case, then on an incremental basis, the worry on interest rate hikes, and hence subsequently the softness of demand should incrementally taper down. And hence it's an incrementally bullish or positive sign, I would say. So what Walmart said is something which is happening, but incrementally going forward, with inflation ebbing and interest rate worries, we will kind of get to know what Fed says in a couple of days' time. Kind of if fears recede to a certain extent over the next couple of months, we are in a good spot.
Pradeep, there was also a data which is floating around in investing circles on probability of a recession, and some 15-16 countries are part of that. And India, the probability is being indicated at 0% probability of a recession. So if the Indian scenario looks so insulated, do you think sometimes we as investors, underrate ourselves and the strength of our own economy?
Absolutely. I think I've been making this point wherever I've been to, that overall, if you look at CY22 and also CY23, our bottom-up story looks fairly robust. And it's fairly robust on the back of, a strong chance of a capex cycle coming about, on the fact that real estate sector, which is an important component of our economy, is also bottoming out. And finally, we are seeing salary increases coming through, so which will be good for consumption spending 9 to 12 months down the line. So three important constituents of the economy kicking into gear. And then if you add on top of it the fact that in 2024, we'll have national elections. And ahead of that, the government narrative is also likely to be pro-growth rather than pro-reforms, like what we have seen in the last 4 or 5 years. We have a very good concoction of a bottom-up story, which is kind of gradually looking up. In that context, we are faced with, or we have been faced with, higher inflation. And being a commodity importer, that has impacted us. But given that those fears are also incrementally receding by the day, I think if you look at it from a 1 to 2 year perspective, we have a very strong bottom-up, domestic cyclical-driven recovery story, which relatively for sure stands out relative to the globe, and probably in absolute terms as well.
Right. Trideep, talk to us about what are the high growth and very comfortable margin themes which are there on your radar to ride out this kind of a market for the next 12 to 24 months.
So I think when you are talking about, so one is the economic themes, which I just talked through: capital, industrials, capital goods, real estate, some parts of consumption spending, which is the 1 to 3 year kind of theme, which is, I would call it in the grand scheme of things, on the shorter time horizon. But if you look at where India is in its evolution path, I would say the three themes which will make money for investors over the next 10 years would be brands, market share gainers, and following basically innovation or innovators. These three themes, in my opinion, are very relevant to where India is in its global evolution. Brands, because India's time for brands has come, given where the per capita GDP today is and where it will be in 10 years' time. Incremental brand adoption will be fairly high. Market share gainers, because over the last 5 years, we have seen a good bit of reforms come through, and we have seen the pain. Now, over the next 5 to 10 years, we'll probably see the gain of market share gain of organized sector at the expense of unorganized sector. And if we carefully play the enablers and adapters in the context of innovation as a theme, we think that these are the three themes which, in my opinion, makes a lot of sense for investors to be part of from a very long-term 5 to 10 years perspective.
Right. Trideep, yes, inflation appears to be peaking out, but how have you scaled back, or have you scaled back at all, the growth estimates of the companies in your portfolio in general, by at large, or not very meaningful yet?
No, so I think we were slightly early on this. I mean, I think we sort of realized that the inflation will probably kind of, eat into. So if you separate out India Inc. into two parts, commodity users and commodity earners, then over the last 6-9 months or 6-7 months, we have seen a good bit of earnings correction that has happened in the case of the commodity users. And the shape of the earnings has shifted more towards commodity earners. So net-net, we haven't seen so much of an earnings cut across the market, but between the segments, there has been a bit of rotation of earnings, so to speak. With inflation ebbing, I think the source of the source of earnings might actually shift back to commodity earners to a certain extent, or commodity users to a certain extent. I would say that with the current quarter is the worst quarter from that perspective, where we are seeing the worst impact of commodities, yet no impact of pricing increases that the companies have taken. Come the second half of this year, we would start seeing some sort of benefit of pricing power also starting to get reflected in companies' financials. So to answer your question, given the verbose commentary that I made, on net balance, we have seen good bit of earnings cut, maybe some bit more remaining, but net in the second half of this year, we will probably see some sort of earnings growth coming back, driven pricing power and areas of the economy which are doing well.
Trideep, can you tell us what valuations right now your portfolios have come down to in terms of, has there been a reasonable correction in the valuation of the stocks which you are holding, and versus the valuations, what kind of growth do they offer 24 months far out?
Great question. So just to put the context for everyone, Indian markets, despite you seeing the levels where they are, have actually derated by 20 to 25% since the beginning of this year. And it is more, it's not subject to the fact that, the growth outlook has dimmed all of a sudden. It is more driven by the fact that the interest rate regime globally and in India has changed, and we've seen meaningful increase in interest rate expectations for the next couple of years. And as that happens, obviously, it acts as a bit of gravity to the valuations of Indian stocks and globally. In India, it has been to the tune of about 20 to 25%. So factoring that in, we are looking at somewhere around 17 to 18 times 1 year forward earnings. And if you look at within pockets in terms of the portfolios that we are at, we are probably looking at somewhere between 20 to 25% growth with regards to the pockets of the market that we own. So our net balance relative to the growth, we are probably in the fair zone. We are not in the kind of deep sort of value zone. We are probably in the fair zone, where we think that as long as we own the right companies which generate the earnings growth that I talked about, the earnings growth will kind of lead to the returns overall for investors.
What about the mid-cap and small-cap end of the basket? Have they come down to attractive valuations yet?
I would say selectively within mid-cap, certainly we see some value emerging overall. Small cap have probably some more room to go. But I would say that if you take a look at mid and small caps as a basket, rather than cutting the spectrum in terms of mid, small, or large, I would actually cut in the sense of the valuation buckets. The high valuation bucket over the last 6 to 9 months is where kind of markets have taken a hammer to, and they've seen valuation correction to the tune of 50% or more. And the lower parts of the valuation bucket have remained where it is. That includes some large cap names, that includes some mid cap names, as well as some small cap names. So in the expensive bucket, particularly where we've seen valuation correction of about 50% we are getting there or thereabouts with regards to fair valuation overall. That's the way I would answer that question.
All right, Trideep, we'll let you go on that one. Thanks so much for joining us with your view on the markets and investing environment. That was Trideep Bhattacharya. Let's take a short break on that note. On the other side, we'll put the spotlight on some of the key earnings which are lined up today, how the stock's positioned ahead of the earnings, what to expect on expectations front, all of that when we return.